Coming up today, stocks continue to rally. What happens when Wall Street catches up? How big can mega cap tech get? Are we reaching extremes? Tesla crushes expectations. What else they just beat on? And the good times continue to roll on. We're making money out here today, guys. Let's go. Wow, what a day out there. This heat map does not tell the true story. S&P 500's only up slightly 0.12%. Other indices up a bit over flat. Once again, a bit of dispersion going on in the sectors, with a few of them being up, a few of them being down. International stock markets largely holding up. Saw a bit of a pullback in commodities today, but it was actually crypto the winner. Best performing asset class out there. But doing even better than crypto is small cap growth stocks. Just looking across my themes watch list. We got robotics lighting up out there today. Names like Rich Tech, Serve Robotics, and even some of the real smaller names, along with other more larger robotic stocks like Symbotic, actually breaking out to a fresh 52-week high, along with many other categories like nuclear, uranium once again pushing up, helping to lift these small modular reactor stocks. Big moves in space-related stocks, AST Space Mobile up 16% today. Small AI stocks as well, SoundHound AI up 10%. The run in quantum has been unbelievable. These are by far the most overvalued stocks out there. Some of them don't even have any revenue yet, and the market continues to run them up. Same with AI-related healthcare stocks. One I added to my long-term portfolio at the start of the year, Grail, more than doubling over the last month. All crypto-related names having a good day, and especially rare earth stocks like USA Rare Earth, up 23% today on monster volume. Absolutely great time to be a small cap investor, and I'm proud to say my stock picks portfolio is sitting at all-time highs, having another good day. Now up 51% in time-weighted returns since starting in June last year, more than double the benchmark Vanguard Small Cap Index Fund. And in fact, just looking at simple returns, now almost triple the small cap benchmark. And even though volatility's been really low as the market continues to grind, it's still been a great environment for options trading as well. Plenty of momentum that we can jump on board with trades shared in our options trading chat room, also performing really well. Now having booked over $16,000 in profits since we started in May. And our new ETF portfolio, we started yesterday off to a great start. Smashing the market there today, up 1.5%, and we're using the Vanguard Total World Stock Index Fund as our benchmark, as we're not just investing in American stock ETFs, but rather all around the world. And in fact, we're also investing in commodity and crypto related ETFs, but there's not really a benchmark that includes all those assets. And so of course, still very early days, but nonetheless, we're off to a strong start. Counts up almost $2,000 already. And just as a quick reminder, if you want to get access to any or all of our premium services, time is running out to lock in a 40% discount expiring this Sunday, the 5th of October. Click the link below this video. Visit my site, clickcapital.io, and use promo code ETF40 at checkout if you want to get access to our stock picks, options trading chat room, and ETF portfolio service. Now is the time to do it. Okay, just getting back to the market, looking at some data. The 2nd of October came in as seasonally expected. S&P was up 12 basis points, right in line with what we normally see in early October. Typically be bullish, but on rather low volatility days. It can be more towards the end of this month. We can see a bit of volatility. And since the S&P 500 just closed at an all-time high, 67.15, you can expect Wall Street to quickly catch up and lifting their year-end price targets once again. They followed the market down through the tariff tantrum. Now they're following it back up. And what's interesting is the Street's average price target for year-end is currently below the market, with the S&P up about 3.5% more than where the Street is currently at. And normally that means the market's going to spend the rest of Q4 chasing. A lot of money follows Wall Street targets and recommendations. And apart from 2012, whenever the S&P is above where the Street is at to start Q4, we typically finish a bit higher, especially in 2020, up about 10% higher. And even in 2012, the market was only slightly lower in Q4. So there definitely could be a bit of chasing going on in Q4. Still plenty of big money sitting on the sidelines, not believing this rally, even though we've now got the largest stock well on its way to hitting 5 trillion for the first time. That's NVDA. Alphabet Google still around 3 trillion, and I wouldn't be surprised if we fast forward 6-12 months and Alphabet Google's actually at number 2 and may even have a chance at overtaking NVIDIA if we do see a pullback in the chips, as Alphabet Google's a much more diversified business, firing on all cylinders as well, with YouTube and Waymo, in addition to their AI strategy, being finally recognized as a leader by the market. And these big companies continue to chew through so much power. We're getting some unbelievable stats. Looking at the share of total electricity consumption estimated to be used by data centers for a few US states, Virginia, 39% of their electricity consumption coming from data centers. And you can see the trends in these charts are up and to the right. Oregon, 33%. Iowa, 18%. That's incredible stuff. And OpenAI just overtook SpaceX as the world's most valuable private company. Most recently been valued at $500 billion. And I think they could very well be on their way to $1 trillion valuation. Interesting to see half of the top 10 list of the world's most valuable private companies coming from China and India. And so we're in the midst of a Capex boom, the likes of which we've never seen before. And the forecasts just keep growing. growing. City Research coming out and forecasting almost $3 trillion in hyperscaler Capex through 2029 as they all reach for the stars. Now got big tech Capex over 1% of GDP. You go back 10 years, it was barely a tenth of 1%. And look at that acceleration over the last year. No doubt it's a massive growth driver out there as tech companies' capital spending becomes a larger and larger part of what's actually driving GDP growth, and very well could be on its way to contributing half of all economic growth. And I'm not trying to pour cold water on a hot market, but buyer beware. We are getting plenty of extreme stats when it comes to large cap growth, big tech stocks, and also unprofitable tech stocks, like I'm about to show you soon. Looking at this chart here of the 3-year annualized return differential between the Russell Growth Index minus the Russell Value Index, nearing extremes where it's previously reversed before. And so in other words, large cap growth stocks are quite expensive relative to small cap value stock. And here's another one, the S&P 500 price to sales ratio, looking at the trailing 12 months, now hitting a record 3.33, well above what we saw in 2000, around 2. Now a big part of this is tech companies. They're much more valued relative to sales, say compared to traditional companies like Walmart. And that's because Walmart has low profit margins, whereas tech has really high profit margins, but still, no doubt things are a little stretched here. And not really a key valuation metric, but still an idea of how expensive the S&P 500 is, with its dividend yield getting down to very similar levels to the late 90s. And probably the most egregious chart of them all, the market cap weightings of tech versus defensives. We've seen a big slide in traditional consumer staple stocks this year, defensive stocks, outside of utilities, of course, which have taken on a whole new life of their own throughout this AI boom, thanks to electricity demand. But looking at those traditional snack makers, they've been hit from multiple angles. A new government and healthcare department going after them, the massive growth in GLP-1 drugs, causing millions of consumers to snack less, but also they just don't have the growth that tech stocks have. But it is hard to ignore the similarities from the late 90s, when we saw a big divergence back then between how big tech was in the market and defensive stocks. Could very well go on for another year or two, but no doubt there's going to likely be a sharp reversion to the mean at some point. And this chart here gives a pretty good idea of what's been going on the last few months. Goldman Sachs quality pair basket, basically long quality stocks, short low quality stocks, mostly measured by profitability. And so there's been a huge rally the last couple of months in non-profitable tech, whilst traditional quality stocks have gone nowhere or down. Now, of course, there's nothing wrong with riding the trends. It's much easier to jump on board what is working now than trying to guess what is going to work next. But with that being said, be mindful not to get too over leveraged. I myself am going to be careful over the next few months with not buying too many unprofitable companies. Because yes, things are going really great now. And again, we should always ride the prevailing trend, but we don't want to get too overexposed, as no doubt a sharp pullback is just around the corner. Even within the bull market, we can see these hot names experience a lot of volatility in the short term. So that's just something to be mindful of, as you don't want to get your portfolio too concentrated to any one theme in the market, even if you are diversified across different sectors. And once again this week, we're just continuing to see weakness in the jobs market. This stage, it's looking like we're not going to get the jobs report tomorrow as regularly scheduled due to the Bureau of Labor Statistics being shut down. US government in its second day of shutdown, the focus will more be on the private payroll, which was actually negative last month, along with employers' plans to continue hiring, also falling off a cliff. In fact, it was the worst month for hiring intentions since 2011, when the market was still recovering from the GFC. The US economy was still weak for a few years there, before eventually coming back. But as we can see on the charts, the stock market doesn't seem to mind about this at all. It's pretty much ignoring every headline at this stage, just grinding on its own. And so what's interesting is the whole dynamic could be changing, the rules of economics, for the first time ever. We may already be a few years into it with the big divergence in the stock market and the jobs market, because typically not only the correlation between a company's revenue and profits usually exists with its growth and headcount, but also at the economy level as well. Typically when we see the working age population grow, that also correlates with GDP growth. But could AI upend this? As plenty of notable figures across finance have already been indicating. Earlier this year, Larry Fink, the CEO of the world's largest asset manager, was quoted as saying, if you forecast out the transformation that we're going to see across all societies because of AI, robotics, and sensor technology, the speed in which this change is going to occur, I could argue in the developed countries, the big winners are countries that have shrinking population. And he's just one of many. I just asked GPT to give me a bunch of quotes from key figures, CEOs, and some of the richest people in the world, what they've said about this, as ranked by their net worth. Elon Musk warns AI automation could destroy jobs. Bill Gates, AI may wipe out many roles. He's advocated policies to manage it. Jensen Huang came in with a good one. Some jobs will be lost. I think he's putting it quite mildly. Eric Schmidt, former CEO of Google, cautioned that AI's evolution has trade-offs, including job displacement. Jack Ma of Alibaba warned that automation automation will replace people if they don't upskill. We're already seeing many tech companies like Salesforce cutting thousands of jobs, saying AI is already handling 50% of their calls. Jamie Dimon was just a piece out earlier this week saying they want to become the world's first AI-driven megabank, completely rewiring their business. Sam Altman, behind GPT, said entire job categories will be totally gone. Amazon, Walmart, the list goes on. They're all rejigging their businesses for AI. And in fact, the guy that's actually known as the godfather of AI helped to create GPT, Geoffrey Hinton, warns of a future where we may no longer be needed. And that's because CFOs out there tasked with creating efficiency in their businesses simply can't ignore AI now. It's too good at unleashing productivity and efficiency gains. They're all in the midst or planning how can they shrink their headcount while still growing profits, because it's possible to do that now. And so because there's real fundamental gains to be had with AI and robotics, it could very well drive this AI boom for a few more years to go. But just like the late 90s, investors were right about the internet. It did grow huge, but the market got too carried away, went vertical, companies ran out of cash, valuations got ridiculous, the Fed hiked rates, and the bubble eventually popped. Just the NASDAQ index coming off 85%. Imagine that today, the NASDAQ coming off 85%. Imagine 98% of these smaller AI companies going bankrupt, thousands of traders and hedge funds getting wiped out. It's hard to imagine, but that's exactly what happened in the early 2000s. So no doubt AI is here to stay and it's only going to grow, but stock valuations, that's another story. And so just moving on to the government shutdown. Looks like we're not going to get the jobs report tomorrow. We may not get inflation readings later on this month as well. The Fed's set to meet on the 28th, coming out with their decision on the 29th. Still widely expected that they'll cut, but they may be left to their own devices to find data to help them make a decision, which is definitely possible from the private sector with companies like Trueflation, I would say, given much more accurate and up-to-date data than what we see from the public agencies, often lagging with many questions of their accuracy as well. Just looking at Polymarket, odds actually increased. It could go on for 2 weeks or longer. Still better than a 50% chance it ends in the next 2 weeks. No doubt this is a fluid situation. But again, just like the jobs market, the stock market simply doesn't care. And that's because the last time we had a big shutdown, back in late 2018, the market actually rallied 10% during that shutdown. Of course, it was off a deeply oversold low, and the Fed pivoted during that time. But nonetheless, we've never seen a double-digit sell-off when the US government has been shut down. Also interesting to see financial media quote prediction markets more and more these days as a trusted source for market-based forecasts, instead of biased single sources. The market always does a much better job at pricing the future than any single or small group of people do. And so with valuations, the jobs market, government shutdown, there's always a reason to sell stocks. Financial media does a good job at creating fear because that's simply what works for them. The most important thing as investors is just staying invested and riding the waves. And this chart here illustrates that point better than others. It makes a great case why you shouldn't day trade, because just holding stocks for one day is only slightly better chance than 50-50 that they'll be up. And I'm sure it's exactly 50-50 if you're only holding stocks for minutes or an hour or two. In addition to paying the spread and getting beat by algos, that's why 95% of retail traders lose at day trading. And I know there's some on this platform that do show it being done profitably, but they're doing it in a live chat room with thousands of their followers following them. In other words, they're just front running all their members. For most retail traders, trying to beat the algos is a losing game. And so anybody trying to sell you a day trading course, ask to see any proof that they actually profitably day trade before you send them their money. Because the easiest way for retail traders to become profitable is simply trade less. Just by holding a stock for 1 month, your odds go up dramatically. 62% chance it'll be profitable. And again, if you hold for a year, there's a 75% chance your stock or ETF will be higher. And the longer you hold, the more guaranteed you are to actually make money. And so that's probably the biggest mistake I see retail traders make, is over trading, trying to respond to every tick in the market, trying to time every top and bottom, along with having unrealistic expectation that they should be profitable every day, every week, every month, every quarter. You got to think of successful trading and investing like running an insurance business. Because when you invest in stocks, you're essentially riding volatility risk premium. And that is, you get paid to tolerate volatility in the market. And if you can, you earn a premium for that. Just like insurance companies get paid to tolerate losses. And if they manage those risks well, then they earn a premium. And so if you're struggling to make money in the market, just try trading less. I'm sure it will improve your results. Just moving on, Tesla, crushing expectations. Looks like there was a bit of a end of quarter rush. Delivering a record 497,000 vehicles, up more than 100,000 from the previous quarter. Also smashing Wall Street expectations of 447,000. And so that was great news to see their main category get back to growth, along with record energy storage deployment up massively from Q3 2024. Their energy business is growing leaps and bounds. And so thanks to that record delivery beat, I think there's a good chance Tesla could beat on their quarterly earnings in a couple of weeks from now when they report on the 22nd. And in fact, myself just having a little fun here on Polymarket. A couple of days ago, I bet $300 that they were going to beat on the next quarterly earnings. Got in at average 46 cents. And I was actually a bit busy yesterday and wasn't looking at this, but if I was, I would have definitely bought the dip as it got down into the low 30s. Because looking back in history, most of the time Tesla does beat. In addition to that likely rush before the EV tax credits rolled out, and just looking at the price action in the stock over the last couple of months running up a lot, there was quite a divergence between what the odds were here on Polymarket that they were going to beat and the stock market. Now they still may not beat, but I think the market's at fair value right now, 77% chance, which I agree with. I think there is about an 80% chance that they will beat on expectations now. But the stock did pull back, even on these good numbers. Like we can see here on the chart, on a big bearish engulfing candle, but I do think that's just a classic buy the rumor, sell the news, because we're only trading back to levels where we were at Tuesday lunchtime. So even though a dramatic candle today, it's really no big deal. And like I said, we've run up more than 50% just in the last 2 months. And so the expectations for this quarter, about 50 cents and earnings per share. You go back to last October's quarter, they actually delivered 72 cents per share. So that's why I thought the hurdle was low to begin with, and 46% odds were good. Just wish I got a chance to double up in the low 30s. But never mind, I'm going to ride that bet all the way through to this quarter. And like I said, just having a bit of fun on prediction markets, nothing too serious. Also interesting to see them report some stats on their supercharging stations, coming through with really impressive growth, 31% year-over-year growth in charging sessions. And who believes this? They actually made 50,000 Tesla burgers at their new diners, selling as many hamburgers in Q3 as the average McDonald's does in the US, despite only opening on July 21st, and the burger costing twice as much. And that's the power of a big brand. You've got millions of people that love. They can come up with practically any product, slap their logo on it, and because they do a quality job, people will buy it. It's the same deal with Apple. They don't need to create any new tech themselves. They just bundle others and slap that Apple logo on it, mark it up 10x, and they will sell it every time. And so when you focus on giving value instead of making money, you end up making more money anyway, just like Elon Musk. Now the first person to reach a net worth of $500 billion, with a very good chance of becoming the world's first trillionaire. And he's just getting started with robotics and space, even though he's been running SpaceX now for 23 years. But that's the difference between Elon Musk and others. Not only is he an autistic genius with the biggest ambitions, he's also the hardest working CEO, working around the clock, often sleeping on the factory floor. Here he is pictured late at night on his birthday, studying his production line. And you contrast that to other billionaires like Jeff Bezos, who's off yachting around the Mediterranean with his plastic wife on his $500 million yacht. Elon doesn't do all that stuff. He's still hyper-focused on scaling all his companies the best he can, spending half of his days with engineers, problem solving, creating efficiency, innovating. And that's why I choose to put my money behind him more than others out there, because I still think Tesla's best days are ahead of it. Even with a market cap of 1.4 trillion, I think we'll look back in the future and see that as being cheap, as crazy as that sounds now. Because I have no doubt in my mind Tesla will become the world's largest company, potentially in the next couple of years, with a successful robo-taxi and Optimus bot rollout. And so Tesla's probably the only stock I can comfortably say I will never completely sell out of. If it's gone to zero, like so many bears hope it does, well then I'm going there with them. I just don't think that's ever going to happen. But no doubt it will always be a very volatile stock with an army of haters, which if they haven't realized already, are simply on the wrong side of history. Anyway, just getting back to the market, the VIX up a little bit here today, really doesn't seem worried that we're not going to get all these important data prints. Jobs, potentially inflation. Bond yields really came off this week, 2-year down to 354, which didn't really cause bonds to go up much. We actually saw a little softness in high yield bonds yesterday. Looks like the dip was bought, and the dollar as well just holding ground here. But what has been doing well and now being called the debasement trade, Bitcoin, Ethereum could very well go for a run towards all-time highs above 5,000 these coming days, as it looks like we did find support around that 3,900 level. Gold as well, still coiling up near all-time highs, and uranium still looking super strong on the chart here, along with one of the ETFs in my ETF portfolio, the Nuclear Renaissance Index. Having another good day there, helping the portfolio perk up right away as we're exposed to a number of different themes across asset classes and the world. It's a great time to be a global momentum investor. And so if you'd like to jump on board with me, you've still got time to save 40%. That's a permanent discount. If you do go with a monthly or yearly plan, otherwise you can get the biggest saving with the lifetime plan, pay a one-time fee. And you can also use this promo code ETF40 on package deals as well, if you also want to get access to my stock picks portfolio and options trading chat room. With all my services, I put my own money behind all the trades that I share with members. You won't find anybody else doing that. They're happy to tell you what to buy without buying it themselves. It's like somebody inviting you over for dinner, making you dinner, and sit down at the table and watch you eat it without them eating it themselves. So if you're struggling to make money in the market, then jump on board a Click Capital Premium service today and join a community of real traders doing this stuff every day. I promise you won't regret it, as this is really a great time to be trading momentum in the markets. So click the link below this video, head on over to my website clickcapital.io and jump on board today before the 40% discount expires this Sunday. Thanks very much for watching. My name's Jared, and I'll be back again this time tomorrow. Cheers.